there's a senior piece, then there's an interim lender, and then the interim lender basically is there for the construction process. And then once the property is built and there is a certificate of occupancy, that piece then gets purchased essentially by the CDC.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Bo Eckstein.
Hello and welcome to another episode of the Investor Financing Podcast, and I'm your host, Bo Eckstein, and today we're going to talk about the 504 debenture and what the heck this is. If you can look on the screen right now, and sorry guys if you're watching or listening on iTunes, but you can go check out the YouTube video after you listen to this. But basically, we're talking about the 504 debenture. So on the example we have on the screen, this is for a construction project, and you can see that the land acquisition price is $250,000. with cost to build or building construction of $750,000. So that's a total of $1 million of costs, right? $1 million of costs. And this is very simple structure. This is just a proposed construction property type of 504 funding. Now, if you go below that, we're going to talk about the way these 504s are structured. So you can see that 50% of project costs are going to be funded with the first mortgage or the senior debt, which will be the bank, credit union, one of the choices there, right? And then you're going to see the next line item is the 504 debenture. Okay, this is the CDC piece. And the CDC is basically a nonprofit. They're regional. There's usually CDCs cover certain geographic areas. And really what they want to do is help that local economy, grow. And so they're looking to put new businesses, small businesses, open doors for small businesses, help small businesses expand. And that's really the purpose of a CDC. They work with SBA and package up the SBA piece or the CDC piece and get approval. So on this, you see that we're going to have a 50% senior piece, which is the bank piece, and then you're going to have the SBA piece or the CDC piece of 40%, and then borrower equity of $100,000, right? So on $1 million project, and this is a rough, there's going to be some other costs that might not be able to be financed. Blue sky and intangibles cannot be financed with a 504, and they can be financed with 7A. But for the purpose of this, we're just going to keep it really simple. And so now the bank might fund initially the CDC or the SBA piece. And upon stabilization and upon certificate of occupancy, that piece then gets purchased, right? That piece then gets purchased and it no longer is held by the bank. And sometimes in some construction deals, there's a senior piece, then there's an interim lender, and then the interim lender basically is there for the construction process. And then once the property is built and there is a certificate of occupancy, that piece then gets purchased essentially by the CDC. And then there's other agencies that work with the CDC to purchase that. So it's kind of a complex process, but really what you need to know is you got your senior piece, You got the CDC piece, which is the second. The senior debt's going to fund 50% of total project costs. Hard assets, they don't fund intangibles. And then the CDC piece or the SBA piece will fund 40% of the project, total project costs. And then borrower equity would be 10%. Now, if it's a special purpose property or a single purpose, special purpose, where there's like one use of the property and doesn't have any other uses, they're going to cut your loan to value down to 85%. So you have to bring in 15%. And in some cases, if this is a startup, you could take another 5% haircut. So you could get 80% total financing. But that's essentially how the debenture, 504 debenture works. Senior piece, SBA piece. During the construction process, it's an interim piece. Once you get certificate of occupancy, CDC purchases that SBA guaranteed piece. If that all makes sense, that's how this whole thing works. Took me a while to get it, but that's how this works with, and even when you're doing a 504 on a stabilized property, meaning is there's no construction, there's a 30 to 90 day window where there's an interim funding, and it takes, and then once the transaction happens and closes, the new buyer is there. The CDC is working in the back, working on the acquisition of that second lien. So there's always an interim lender involved, whether it's construction or a stabilized property on the 504. So I hope that somewhat explains the 504 debenture to you, and you can get a better understanding of the 504 loan, which is a versatile tool. And I always also like to say that you can also, not all lenders will work this way, you can also pair a 504 with the 7A. Because remember, I mentioned that you can't finance the blue sky or the intangible, the non-hard assets with the 504. Well, you can with the 7A. So that's huge. If you can fill the gap and bring in less capital, that's the kind of name of the game with most people out there that are buying these businesses or building these, expanding and building a new property, right? We want to leverage. And so that's a 504 with a 7A companion. So that's also an option. Not all banks do that. 7As usually like to be 100% collateralized. So on something like that, they might want to collateralize on a second lien on a primary residence or a rental property that you do own. So you got to be aware the 7A is always going to look to collateralize. But if you're looking for high leverage, this is the way to do it. And potentially you could even bring in you could have the seller carry a small piece back too. So we could lessen the equity infusion that you need to put in to the deal. And so I'm working on a few of these right now. There's certain rules, but that's really how you get the most leverage on using a 504. And a 504 would be for equipment, machinery, hard assets, or real estate. Whereas a 7A is more for business. Could be buying a franchise. It could be buying existing business. But also, kind of circling back with all this, a 7A is also a great tool because a 7A can be used for construction. You can't, it won't work necessarily the same way with a 504 in a construction stack, but you can use a 7A essentially, for an example, for senior debt to build a hotel or to build self-storage. So you can use a 7A as well. I would say the 504, overall, the blended rate on a 504, because remember there's two pieces. There's a CDC piece, which is on a real estate transaction is a 25-year amortized loan and the rate's fixed. And then that works with senior debt. And that could be a 5-year fixed, amortized over 30 or whatever was negotiated. Whatever bank you're working with, every bank has a little bit different appetite. But this is the basic structure, and it's very effective for owner user type businesses. Could be large renovation, could be ground up construction, could be buying a stabilized real estate property, could be buying machinery. Just a really, really good product. And that's why I'm doing a lot of podcasts on this. Anyways, please like, subscribe. I hope you got a lot of value out of this episode. I look forward to seeing you on the next episode. And thank you, as always, for being a loyal fan of the show. Really appreciate it. And if you have any SBA questions, go ahead and book a call with me, or any loan questions to that fact. I'm happy to help you any way I can. We have experience with all different types of funding, from bridge funding to multifamily to all different, anything real estate related. I should be able to give you at least some value in a conversation. All right, guys, thank you so much as always, and you have a great day. Talk to you soon.